So today's client has about $620,000 worth of investable assets. They're in their early 60s and they want to know if they can retire today. We're going to jump into a planning session to see if that's the case. All right, so here we have our client. If we look at the age, 61 and 62, they've got a net worth of about $740,000 with investments equal to about $623,000. So the question is, if this client retires today, could they make it all the way to age 100? Well, let's jump over to reports and take a look. So first of all, we start with income, and their income today would be $31,500. Now we see it rises by about $13,000 in that following year. The reason is because their dates of birth are later in the year, so they don't receive a full 12 months of Social Security benefits. And we can see that by clicking on income flows. And if we take a look, they've got a couple pensions here, and then they've got a Social Security benefit right there of $22,000 in the first year, but then $34,000 in the second. So we know that that's age-based. They didn't get a full 12 months, and in that second year, they do assume a full 12 months. Now, going back to cash flow, let's take a look at their expenses next. Now, in the expense column, about $94,000 per year is what they're spending. If we click on total expenses, we can see that they have everything other than their mortgage, about $60,000 or $5,000 per month. And then they have liability payments, a little high here for a retiree, about $27,000 per year. That includes their mortgage, and it's impounded with their property tax and insurance. They have some tax here to be paid, $7,600 per year, and the total for the year is that $94,000. Now, moving back to the cash flow statement, and that one of those final columns here is their net cash flow. And we see that it's negative. And that's pretty obvious because their expenses are higher than their income. And that negative shortfall is pulled from their assets. That shortfall is pulled from their portfolio assets. And we can see that they're on a schedule for depletion. And the reason is because that withdrawal is too great as a percentage. It's too great. It's more than what we can do in the market. So as time goes forward, we see that this client eventually runs out of money down here at the age of 78 and 80. So they've got about 17 or 18 years worth of retirement before they're out of money. So I like to jump into the withdrawals to see as a percentage how much we're taking from the assets, and it's right here. So we've got 64,000 coming off to make up their shortfall. And if we divide that by their total portfolio, the 623, it's about 10% per year. Now, it's a little less in subsequent years, and the reason is because that Social Security benefit, when they get a full 12 months, they have more income. They don't need as much from their retirement savings accounts, so it's a little smaller. But we see that over time, the assets, because the assets cannot keep up with their withdrawals, that percentage gets higher and higher because the account balance gets smaller and they still need the same amount. It's a little higher every year because of inflation, but they still have a shortfall that's about $55,000 to $60,000 per year coming off that balance. And as it's smaller, that percentage gets higher. And eventually it becomes 100% of the account value here down at the age in 2040 at 70, 79 and 81, 78, 80. Right in there, they're out of money. So as a recap, we know the client wants to retire today, but it's just not possible. And that's because their expenses are so much greater than their income that as a percentage from their assets are more than what those assets can produce on an annual basis. Now, there are a few different options the client has. The first is to reduce those expenses, which I've talked to the client and they are not able to do. The second is going to be for those retirement savings, those assets, to produce a greater annual rate of return, which also isn't possible because their time horizon, the amount of years they have to retirement is too short, so they can't take another big hit. And then lastly is going to be the time to retirement. So adding a few years before their retirement, before their current age in retirement, could be a potential solution. And it's actually the one we are going to go with today. So I'm going to jump back to the planning session and show you guys how that looks. So we're back here in the plan, and I'm going to go ahead and change it to one that I pre-built with the client retiring a few years later. And so now we have them retiring at the age of 64 and 66, and we can see their income now is about $55,000. It's higher than it was if they were to start today, and the reason is because their Social Security benefits and pensions have grown with COLA. Now, looking at their expenses are higher here in those first few years while they continue to work because they'll pay more tax. But the important takeaway is going to be this net cash flow. It's now positive through those next 3 years before retirement, and that's added to their portfolio. And now those portfolio assets go to about $800,000 by the time they retire. They got a $36,000 annual shortfall, and that's coming off those assets. But those assets are big enough now to sustain that withdrawal. And we can see that they have slight appreciation over time. Not a whole lot, but enough to sustain the plan. And they end up down here with about $1 million when they pass away at about the age 100. Now, looking back at that withdrawals report, let's take a look at the percentage here. So we see their $36,000 coming off that 800, and that's about 4.5%. So again, we're targeting 4 to 6% for retirees to be conservative, and this is achievable. And we can see it does grow slightly over time, and it gets higher and to about 6% when they hit age 100. But throughout retirement, it is within that 4 to 6% range, which is what we are looking for. So with that said, this client has a very good shot at a successful retirement. If in fact they do work for a few more years, they will have enough in their retirement savings to sustain that shortfall over the next 25 or 30 years. So there it is. It's not necessarily what every client wants to hear, that you have to work a little longer. But quite honestly, the biggest lever for retirees and finding themselves a successful plan is going to be working a little longer. It's very unlikely that they're going to have more discretionary income to add to those portfolios. It's unlikely for them to achieve a higher rate of return because, again, they can't take the same risks they were taking when they were younger because retirement's too close. And oftentimes expenses, they usually stay about the same throughout retirement. If you've got liabilities like a mortgage that's going to get paid off within the next few years, that can be key, allowing them to retire today, knowing that that mortgage or liability will be paid off a few years later. But that's not the case for this client. So it just so happens that this client needs to continue working for a few more years. And in doing so, that portfolio will be able to maintain those withdrawals for that annual shortfall. So if you would like a professional opinion of whether or not you can retire today, reach out to us. We also offer other services like tax planning, insurance products such as long-term care life insurance, and we do work with fixed rates and products that have downside protection while providing you the flexibility of some upside returns. You're more than welcome to reach us by email, by phone, or here on the social platform you're watching this video today. Thank you so much for tuning in, and we hope that you guys enjoyed today's session.